Welcome to XM.com. You're watching the Daily Market Comment by Mario Hadjikyriacos for Tuesday, June 28th. I'm Cristina Marujos. Oil prices edged higher for a third session on Tuesday, following reports that major producers such as the United Arab Emirates and Saudi Arabia are either completely tapped out or have little spare capacity to boost output. Worries over shortages in energy markets have returned with a vengeance, overpowering recession concerns that hammered prices this month. The trajectory of energy prices is arguably what will determine the path for every other asset class, bearing in mind the spillover effects on consumers, inflation expectations, and central banks. Take currency markets. Persistently high oil prices suggest wider trade deficits for the euro and yen, accompanied by slower growth in those economies, diminishing the prospect of any sustained recovery. It's a similar story for stock markets. If oil prices finally cool down, that could torpedo inflation expectations and in turn lessen the pressure on the Fed to raise interest rates with reckless abandon. A simple rule of thumb is that elevated energy prices favor the status quo, a strong dollar, higher bond yields, and fragile stock markets, whereas any sustained decline could plant the seeds for trend reversals. In this respect, tomorrow's OPEC meeting could have implications for assets far beyond oil. Crossing into the currency complex, the Canadian dollar has been a clear outperformer recently, drawing its strength from its sensitivity to oil prices. Aside from that, though, there haven't been any groundbreaking moves, with most major FX pairs trading in relatively narrow ranges. One exception has been the yen, which has resumed its downfall, although it hasn't broken to new lows. On the bright side, this downtrend might be entering its final phase. The currency collapse has turned into a political issue, which suggests there is a floor for the yen somewhere. Either inflation will fire up and the Bank of Japan will pivot, or the crash will become unbearable politically and provoke FX intervention, or global recession worries will drag foreign yields down. One way or another, there is some light at the end of the tunnel for the devastated yen. Despite a solid set of data that dispelled some growth concerns, Wall Street closed in the red on Monday, pressured by the steady recovery and Treasury yields and energy prices. The spotlight will fall on the European Central Bank Forum in Portugal. Euro traders will tune in for any details around the anti-fragmentation strategy that the European Central Bank will likely unveil next month to prevent panic in southern European bond markets as it raises interest rates. Thank you for watching the Daily Market Comment here at XM.com.